Hello, I'm Aidan Sutton. I'm a partner who leads our social business tax practice. With me today I have Neil Higgins, who's an operational taxes specialist, and Iain Sanderson, a senior manager in our social business tax team. Today we'll be discussing the Common Reporting Standard, or CRS, and its application to charities. So first, Neil, can you tell us a bit about what the Common Reporting Standard is?
The Common Reporting Standard forms part of the recent tax transparency agenda, and it is looking to tackle or provide information to tax authorities around tax evasion by, from a UK point of view, UK tax residents potentially using overseas bank accounts or overseas structures to avoid UK tax. There is a previous regime called the Foreign Account Tax Compliance Act, which was a US regime, which first came to light in 2010 and was largely taken and implemented globally around 2014, with over 100 countries signing up to work with the US to report on US tax residents who had accounts overseas. CRS takes that a bit further, so whereas under the Foreign Account FATCA, the UK would exchange information with the US, under the Common Reporting Standard, the UK could be exchanging information with up to 100 different countries. So the European bloc, Australia, Canada, New Zealand, etc. And obviously the UK will receive information back. So that's the Common Reporting Standard. Under FATCA, charities were largely exempted because that was looking at it from a US point of view of risk. However, under the Common Reporting Standard, because it's largely been led by a European core of countries and is guided by the OECD, the charities that were exempt for FATCA are no longer exempt for CRS.
You'd imagine that charities are kind of above suspicion, so why are they included in CRS?
From a Common Reporting Standard point of view, the main driver is based in a 2008 OECD report that looked at the abuse of charities in terms of money laundering and tax evasion. Numerous countries contributed to that, including the UK, and I think they've seen this Common Reporting Standard and the fact that this information will be collected automatically and exchanged automatically as one tool that they can use to maybe tackle that perceived abuse.
So if we accept the fact that charities are in this, whether they like it or not, Iain, what practically are they going to need to do in order to comply with this new set of rules? Well,
HMRC estimate that about 8,000 charities are going to be caught by this, so quite a wide spread of charities. But not every charity will be caught. So firstly, they'll have to determine whether they are what's called a financial institution under the CRS rules. If they're a financial institution, then they will be caught in the reporting regime. So to be a financial institution, broadly, over 50% of their income must come from investments. There is a bit of a grey area around actually whether qualifying donations from subsidiaries of charities to the parent will qualify as investment income for these purposes, and we're waiting for further guidance from HMRC to determine this. But in the meantime, the legislation came in with effect from the 1st of January 2016, so charities really need to start now thinking, are they a financial institution or not? If they are, then you start collecting information around the beneficiaries of payments that they've been making overseas and asking those individuals to or entities to self-certify their status for CRS. Charities may have already started receiving forms for their banks as well, asking them to certify their status for CRS. And they'll have noticed those that have, the forms run to about 5 pages, are quite unwieldy. They might not be suitable for sending to overseas beneficiaries. So we've been working with a number of charities and entities to help them actually simplify those forms, but still collect the right information required for reporting. So once all the information has been collected, they will then have to report in May 2017. So quite a short timescale now between now and the first reporting. So charities really now need to focus on what their CRS entity classification is.
Thank you very much, Iain. So we've heard today that Common Reporting Standard is going to impact charities where more than 50% of their income is from investments. Charities need to act now to determine what action they need to take and put systems in place to gather the necessary information and, where required, report to HMRC. Please contact one of today's panel or your local PwC contact if you'd like to discuss in more detail how this will affect your charity.